All right, let's dive into some really foundational concepts in the world of accounting and tax. We're going to be talking about basis, original issue discount, and loan impairment. Now, these might sound like dry, technical terms, but trust me, they're the absolute bedrock, the lawful roots for how we value investments and figure out taxes. Let's get to it.
So here's our game plan. We're going to start with the absolute foundation, which is basis. From there, we'll see how something called original issue discount can change it. And then we'll get into what happens when a loan starts to look shaky. By the time we're done, you'll see exactly how all these pieces are designed to fit together perfectly. Okay, first things first, basis. You really have to get this right because literally everything else we talk about today, every calculation for a gain, a loss, you name it, it all starts from this one number.
So what is basis? Well, put simply, it's your cost. It's the official starting line. You can even think of it, as the IRS puts it in Publication 550, as your skin in the game. It's what you've put in, and it's the number we use to figure out if you've made money or lost money later on.
And this right here is probably the most crucial distinction of all. Your basis is your capital. It's your investment. It is not income. You haven't actually made a single penny in profit until you've at least gotten your basis back. It's like getting your seed money back before you can start counting the winnings.
And listen, this isn't just some good idea or a best practice. It is black-letter law. Section 1012 of the Internal Revenue Code puts it about as plainly as you can. The basis of property shall be the costs. Full stop. This is the legal anchor for everything that follows.
All right, we've laid the foundation with basis. Now let's add a little bit of a twist. We're going to talk about original issue discount, or OID for short. This is kind of a funny concept. It's like imputed interest. It's interest the law says you've earned and have to report even if you haven't seen a dime of it in cash yet.
In a nutshell, OID happens when you buy a debt instrument, like a T-bill, for less than its face value. So, say you buy a bill for $9,800 that you know will be worth $10,000 at maturity. Well, that $200 difference, that's the OID. And you have to treat it as interest income that you earn over the life of that bill.
And as you can see here, the math couldn't be simpler. You just take the redemption price, that's what you get back at the end, and subtract the issue price, what you paid up front. The difference? That's your OID.
Now here's where it gets really interesting, where it all connects back. Let's walk through our T-bill example. You start with a basis of $9,800. As you recognize that $200 of OID is income, you also get to add it to your basis. So by the time that bill matures, your basis is grown to $10,000. So when you get your 10 grand back, your gain is zero. This is a really elegant system, and it prevents you from being taxed twice on the same money.
Okay, so let's zoom out a bit and see how these three big ideas, basis, income, and gain, are all integrated. This isn't random. The law has a very specific, non-negotiable order for how we have to think about them. And I really want to stress, this is not a suggestion. This is the lawful flow. Section 1012 nails down your basis. Section 451 tells you when to recognize your income. And only then does Section 1001 let you calculate a gain, which is defined as what you get above your adjusted basis. The order here is absolutely critical.
Look, if there is one thing you burn into your brain from this section, let it be this. B-I-G. Basis, then income, then gain. It's a super simple mnemonic, but it is your cheat code for remembering the correct legal and economic order of operations every single time.
So we've spent a lot of time talking about how value is created and taxed when things go right. But what happens when investment goes south? Now we're going to pivot and dive into loan impairment under US GAAP. This is the rulebook for what to do when it looks like you might not get paid back. At its core, impairment accounting is all about answering one single, incredibly important question. What on earth do you do when it becomes likely that you are not going to collect all the money you're owed on a loan?
And here we have the legal trigger right from the source, ASC 310. A loan is officially impaired when it becomes probable, not just possible, but probable that you won't collect all the amounts due according to the original terms. Every single one of those words, probable, all, original, is critical.
So once you've determined a loan is impaired, you have to measure the loss. ASC 310 gives you a menu, but it's a short one. You get 3 and only 3 ways to do it. You can use the present value of the cash flows you do expect to get, the loan's current market price, or the value of the collateral. That's it. No fourth option.
To help you remember that legal test we just talked about, here is another fantastic mnemonic. PALO. Is it probable you won't collect all the money according to the original terms? If you can answer yes to that, congratulations, you've got an impaired loan on your hands.
Now, the world of impairment accounting has actually been turned completely on its head in the last few years. So let's compare the old rule, ASC 310, with the new, much more forward-looking standard, ASC 326, which you probably know as CECL. This was a seismic shift, and it's had a huge impact on lenders.
So the biggest difference between the old way and the new way is all about timing. Under the old incurred loss model, you basically had to wait for a loss to become probable before you could book it. But now, under the new expected loss model, you have to estimate all the future losses you expect over the entire life of the loan from day one and record them immediately.
This slide really boils it all down, doesn't it? We have moved from a reactive model, where we wait for bad things to happen, to a much more proactive model, where we have to try and predict them from the very beginning. It's a fundamental change in philosophy.
Okay, for our final section, let's get practical. Let's talk about documentation. How do you build an audit trail that can actually withstand the scrutiny of an auditor? We're going to walk through 8 essential steps. Just think of them as 8 breadcrumbs that lead to an audit-proof conclusion.
And here they are. This is the 8-step process for building a rock-solid audit trail. You identify your loans, you look for the red flags, you apply that probable test, you pick one of the 3 measurement methods, you do the math, you book the entry, you keep an eye on it, and you disclose it correctly. If you skip a step, you're just asking for trouble with your auditors.
You know, following these breadcrumbs does something incredibly powerful. It takes your impairment analysis from just being a bunch of numbers on a spreadsheet and turns it into irrefutable evidence. This isn't just about getting the accounting right. It's about being able to prove you got it right, lawfully and defensibly.
So, we'll leave you with this final thought. Your financial records always tell a story. And now that we've gone through basis and income and impairment, maybe take a fresh look at your own records. Are they telling a clear story? Is it accurate? And most importantly, is that story audit-proof?